a trillion-dollar company, one of the most famous stocks on earth. A company that has created millionaires, destroyed short sellers, and turned a car brand into something almost religious. And now one of the biggest banks in the world is saying it could crash 60%. Not 10%, not 20%, 60%. That sounds insane. Because Tesla is not just a stock. It's a belief system, a future story, a symbol of innovation, AI, autonomy, robots, and Elon Musk himself. So here's the real question. Can Tesla stock really collapse 60%? Or is Wall Street still missing what Tesla actually is? Because once you look under the hood, you realize this isn't just about one company. It's about one of the biggest investing questions of our time. How much of Tesla's value is real and how much of it is just hope? Let's start with what just happened. JP Morgan analyst Ryan Brinkman doubled down on one of the most bearish calls on Wall Street. He kept a $145 price target on Tesla, roughly 60% below where the stock was trading this week. His argument was simple. Tesla's business performance has weakened while the stock still prices in a much stronger future. And the timing matters because this warning didn't come out of nowhere. It came right after Tesla reported disappointing first-quarter numbers. Vehicle deliveries came in at about 358,000, below many analyst expectations, while Tesla also produced more than 50,000 cars than it sold, signaling a major inventory build. That matters, because Tesla is not priced like a struggling automaker. It's priced like a company that's supposed to dominate the future. And that creates a very strange paradox. Tesla's business expectations have come down, but for long stretches, its stock price stayed far above what a normal car company would deserve. That's the heart of this story. And to understand why that matters, we need to understand what Tesla stock actually is. Because Tesla is not really traded like a normal car company. Not even close. Tesla stock operates on two layers. Layer 1 is the real business. This is the boring part. The actual company. Cars, factories, margins, inventory, competition, deliveries, cash flow. This is where analysts usually live. And if you look only at this layer, Tesla starts looking a lot less magical. Because on the real business side, investors are seeing some uncomfortable things. Deliveries are no longer exploding the way they once did. Pricing pressure has hurt margins. Competition has intensified globally. And EV demand is no longer moving in a straight line up forever. Now here's layer 2, the future fantasy. And this is where Tesla becomes different. Because Tesla is not just valued for what it is today. It's valued for what people think it might become. Robotaxis, full self-driving, AI, humanoid robots, energy dominance, maybe even something bigger than a car company entirely. And this is the key. Tesla stock is not just a valuation of current earnings. It is a valuation of a future story. That's why traditional valuation metrics often look absurd. At the time of this discussion, Tesla was trading at a very elevated earnings multiple, far above typical automakers, while the market cap still hovered around $1.4 trillion. That tells you something important. The market is not buying Tesla for what it earned yesterday. It's buying Tesla for what it might dominate tomorrow. And that creates a dangerous setup. Because if the future story keeps getting delayed, then the present numbers suddenly matter a lot more. Think of Tesla stock like a skyscraper. The bottom floors are the real business, selling cars, generating profit, maintaining margins, funding operations. But the top floors, that's the dream. That's autonomy, AI, robotaxis, Optimus, future software margins. And for years, investors were willing to keep building higher and higher floors, even while the foundation underneath got less impressive. That works until it doesn't. Because if the base weakens too much, the dream becomes expensive to hold. And this is exactly what bearish analysts are pointing at. JP Morgan's argument is not just that Tesla had one bad quarter. It's deeper than that. They're basically saying the stock still reflects a future so big that the current business no longer supports the bridge to get there. That's a brutal statement because it means Tesla's problem is not just sales, it's expectation mismatch. An expectation mismatch is where high-flying stocks become dangerous. Because when a stock is priced for greatness, even good enough can feel like failure. Now let's talk about the actual turning point. Because the danger for Tesla is not just that deliveries missed. The danger is that the market may slowly start asking a much more dangerous question. What if the future takes longer than investors thought? That question is lethal for a stock like Tesla. Because Tesla's valuation is not built on 2026 alone. It's built on a much bigger promise. And that promise has to survive delays, capital intensity, execution risk, and investor patience. That's hard, especially when the current business is showing cracks. Let's look at the warning signs. Tesla's Q1 deliveries came in weaker than many expected, which immediately hit sentiment. Inventory is building. Producing tens of thousands more vehicles than you sold is not a tiny issue. It suggests one of two things. Either demand is softer than expected, or the company pushed production ahead of real market absorption. Neither is great. Energy also disappointed. Tesla's energy storage deployments missed some expectations too, and that matters because bulls often pitch energy as part of the long-term upside story. And then there's cash flow pressure. This is where things get very real. Because futuristic projects are expensive, robotaxis are expensive, AI infrastructure is expensive, Optimus is expensive, scaling new platforms is expensive, dreams cost money. And that money has to come from somewhere, usually from the boring car business. That's the real turning point in this story, because if Tesla's current business weakens, then funding the future becomes harder. And once that happens, the fantasy starts depending on faith. So what happens if JP Morgan is even partially right? What if Tesla doesn't need to fall 60% to prove the point? What if it just needs to fall enough for investors to stop treating it like a guaranteed future monopoly? That alone would matter a lot, because Tesla doesn't just influence Tesla holders. It influences retail investor psychology, growth stock sentiment, EV valuations, AI-adjacent hype trades, and the idea that story stocks always come back. That's why this matters. Because Tesla is not just a stock, it's a market symbol. And if symbols crack, they take sentiment with them. Tesla has one of the most emotionally invested shareholder bases in the market. That's both its superpower and its risk. Because emotional investors often don't just own the stock, they identify with it. And when identity gets tied to an investment, objectivity disappears. That's dangerous. Then there's the EV sector itself. If Tesla starts getting valued more like an automaker and less like a future tech empire, that could spill over into other EV names too. Because Tesla sets the emotional temperature of the sector. And maybe the biggest consequence is what happens to the broader market. When liquidity is easy and optimism is high, the market loves long-dated dreams. But when growth gets questioned, the market suddenly wants cash flow, proof, and discipline. That's when hype multiples compress. And when hype multiples compress, they compress hard. And this is why Tesla is such an important stock to study. Because Tesla is basically a live experiment in how modern markets price the future. It shows us something deeper about investing today. Markets are no longer just valuing companies based on what they do. They are increasingly valuing them based on what they could someday dominate. That can create enormous upside. But it also creates dangerous fragility. Because the farther a valuation moves away from current reality, the more painful the correction becomes if the future gets delayed. And that's the modern investing trap. Not bad companies, not even necessarily fake companies, but companies where the stock gets too far ahead of the business. That's what makes Tesla fascinating and terrifying. Because depending on how you look at it, Tesla is either one of the most visionary companies of the century or one of the most aggressively priced future stories ever sold to the market. And both can be true at the same time. That's what makes this stock so hard, and why so many investors get it wrong. Because Tesla doesn't trade like a spreadsheet. It trades like a belief. And that brings us to the uncomfortable truth. JP Morgan may not be exactly right. Maybe Tesla doesn't crash 60%. Maybe robotaxis work. Maybe Optimus becomes real. Maybe the future story actually arrives. That's possible, but the real lesson is bigger than Tesla. It's this. The more a stock is priced for perfection, the less room it has for reality. And Tesla may be one of the clearest examples of that in the entire market. Because in the end, this is not just a debate about one stock. It's a debate about whether investors are buying a business or buying a dream. So here's the real question. Is Tesla still one of the greatest growth stories in the market? Or is Wall Street finally starting to realize the dream got priced in too early? Let me know what you think in the comments.